Ever feel like you have to become a multi-millionaire just to retire comfortably? These days, you'll hear people throwing out numbers like, you need 5 million, maybe even 10 million just to stop working. But here's the thing, that's a myth. What if I told you, with less than $500,000 and the right dividend strategy, you could lock in 7% yields, live off nearly $3,000 a month in income, and never touch your principal? Let's dive in. In this video, you'll get a complete plan to retire happy without needing millions. You'll learn how to build a 7% plus income stream, why this yield is so powerful for retirement freedom, and the 3 dividend assets that can get you there, including one paying nearly 10%. By the end, you'll have a clear blueprint to generate nearly $3,000 per month in dividends, enough to cover your lifestyle comfortably year after year. Golf is a unique sport. You're not trying to outrun someone or slam a ball past a defender. It's just you, the course, and your own consistency. That's why it messes with people's heads, because you can't brute force your way to a win. And investing for retirement? It's the same game. You're not competing with other investors. You're trying to beat the course, navigate inflation, market dips, economic uncertainty, and walk away with a score that gets you to freedom. And just like in golf, the goal isn't to copy what others are doing. It's about focusing on what you actually need after retirement. If you already own your home, your biggest expenses shrink to basics: property taxes, utilities, food, insurance, the occasional Netflix binge, and maybe a road trip or two. Realistically, that's about $3,000 a month, or roughly $35,000 per year. Not a Malibu mansion lifestyle, but still very comfortable. Now, let's work backwards. If your portfolio gives you a 5% return, you need $700,000 to generate that $35,000. But what if you could earn 10%? You'd only need $350,000. Sounds great, right? But here's the problem. Consistently pulling 10% a year is a fantasy. It's a roller coaster ride with risks you can't afford in retirement. That's why the sweet spot is a sustainable 7% return, not a moonshot, just a realistic target with the right strategy. At 7%, you'd only need $500,000 to fund a $35,000 per year lifestyle. That's a game changer, and it flips the script on everything we've been told about needing millions to retire. And the best part, there are 3 dividend-paying assets that can help us hit that 7% mark without taking on reckless risks. First up, UMH. UMH Properties is one of those quietly brilliant businesses that thrives in the background, while the rest of the market chases shiny objects. It's a real estate investment trust, a REIT, that owns and operates manufactured home communities across states like Ohio, Pennsylvania, New Jersey, and down into the Carolinas. In plain English, they rent land to people who own their mobile homes, and also rent out homes they own themselves. The result? Steady cash flow, low turnover, and a product that never goes out of style: affordable housing. I'll admit, I was a little skeptical at first, but once I dug in, I realized this wasn't some rundown trailer park play. Right now, UMH pays a 7.4% dividend yield, almost double what you'd get from many traditional dividend stocks. And no, this isn't a yield trap. That dividend is funded by real recurring rental income across more than 26,000 home sites spread across 140 plus communities. And here's the kicker. As housing costs keep rising, demand for manufactured homes is growing too. This is one of the few real estate models where inflation actually works in your favor. Now, is the dividend safe? Well, occupancy is running at 94.6%. That's strong. And UMH is covering its dividend with about 85 to 95% of real cash income. That's a solid margin, especially for a company still investing in growth. And UMH is growing. They recently raised the dividend nearly 5%, a clear signal of confidence. They're expanding into self-storage, adding more rental homes, and upgrading their communities, not just coasting. Yes, they use some debt to fuel growth, but their leverage is moderate and well managed, with a healthy debt-to-equity ratio and no signs of overextension. Of course, nothing's perfect. If the economy takes a dive, or if interest rates spike sharply, there could be some pressure on returns. But here's what won't change: the growing demand for affordable housing, and UMH is positioned right at the heart of that trend. So while others chase growth stocks or low-yield blue chips, UMH offers something better: reliability, inflation resistance, and a yield built to last. With a 7.4% dividend, backed by real homes and real people paying rent, this is a strong first step toward that $35,000 a year retirement income target. And we're just getting started, because the next asset on our list, it comes with an even higher yield. PRIF, Priority Income Fund. Now, this isn't your typical dividend stock. It's a preferred share issued by a closed-end fund that lends money to mid-sized U.S. companies, mostly through senior secured loans and collateralized loan obligations. In simple terms, PRIF borrows at low rates and lends at higher rates, under agreements that prioritize its position if anything goes sideways. That spread is what generates a whopping 7.7% yield. Yes, you heard that right. The fund holds a diversified portfolio, 261 investments, providing exposure to over 2,350 senior secured loans across more than 1,600 issuers. But as with any high yield, there's risk. Many of these loans are below investment grade, meaning the fund is lending to businesses with less than stellar credit histories. And yes, PRIF uses leverage to amplify returns. So why do many income investors still like it? Because risk management here is solid. PRIF's portfolio is well diversified. No single borrower can sink the ship. Its largest exposure to any one borrower is just 0.81%. The average exposure per borrower? Just 0.06%. And even across the top 10 borrowers, total exposure is only 5.46%. Plus, these loans are backed by collateral. If something goes wrong, there's a built-in cushion to help protect the fund. How about dividend sustainability? So far, very strong. PRIF has paid a consistent 0.375 quarterly dividend since late 2022, holding steady even through shifting markets. And because these are preferred shares, those payments take priority over common dividends. Bottom line, PRIF isn't a growth play. It's an income engine aimed at delivering high, steady yield for investors more focused on cash flow than capital gains. And just like UMH, a $500,000 position in PRIF would move you that much closer to funding a $35,000 a year retirement without touching principal. It's exactly the kind of strategy that can turn market volatility into consistent monthly income. But stay tuned, because the next asset on our list, it brings even more yield and a whole new flavor of income you won't want to miss. SLRC. SLR Investment Corp, or SLRC, is a business development company, or BDC. In simple terms, they lend money to smaller and mid-sized companies that big banks usually ignore. But they're not handing out risky, unsecured loans. Over 95% of SLRC's portfolio is tied up in senior secured loans, meaning if a borrower fails to pay, SLRC is first in line to get their money back. It's like lending someone money and holding the title to their house. And of course, they earn interest on those loans, then pass most of that income along to shareholders. Right now, SLRC is paying out 0.41 cent per quarter, or $1.64 annually, with shares trading around $16.70. That works out to a yield of about 9.8%. Now, when retirees see a yield that high, the first instinct is, what's the catch? And that's a fair question. On paper, SLRC's payout ratio looks a little tight, just over 100% of accounting earnings. Sounds scary? Here's the twist. Those earnings include a lot of non-cash noise. What really matters is cold, hard cash flow. And on that front, SLRC is paying out just 24% of its free cash flow. Translation: they've got plenty of room to breathe, and then some. Another plus? A few years ago, SLRC brought management in-house, cutting fees, improving control, and streamlining decisions. You'd be surprised how many firms still outsource that. Of course, no investment is risk-free. If the economy hits a wall, some borrowers could fall behind. But just like PRIF, SLRC runs a highly diversified portfolio, 940 unique issuers across more than 105 industries. That means an average exposure of only 0.1% per issuer. And with 96.4% of the portfolio in senior secured loans and 99% first lien, the fund stays positioned to weather economic turbulence. Since these are private loans, they aren't exactly liquid. You can't snap your fingers and sell them like a stock. But for long-term income seekers, SLRC setup is very strong. This isn't some moonshot stock trying to 10x your money. It's a monthly income machine, steady, grounded, and built to deliver. Run the numbers. If you invested $500,000 here, you could be generating close to $50,000 a year in income. That's a full retirement income without ever touching your principal. So, what happens if we simply split our portfolio evenly across these three assets? Add up the yields: 7.4% from UMH, 7.7% from PRIF, and 9.8% from SLRC. Divide by 3, and you land at an average yield of about 8.3%. Now, here's the fun part. If you want $35,000 in annual passive income, just divide that by 8.3%. That means you'd only need around $422,000 invested, even less than $500,000. Now, here's where it gets interesting. You can fine-tune this strategy depending on your personal risk comfort. Want to lean a little safer? Allocate more to UMH and PRIF. Want to chase a higher yield? Tilt toward SLRC. It's totally your call. With a $500,000 portfolio, you're generating close to $3,000 a month like clockwork. And here's the kicker. If you don't spend it all, you can simply reinvest the extra. Month by month, those reinvested dividends start compounding. More shares, more income, and more financial freedom. 3 dividend machines, 1 simple retirement strategy. This is how real people live off dividends, not by chasing hype, but by stacking smart, sustainable income. And once you see it working, it's hard to imagine retirement any other way. Still hungry for more game-changing strategies? Just tap the video on your screen and let's keep building your income plan together.